All right, so let's begin the show. And with 50 BPS rate cut, it's definitely looks like an aggressive start of the rate cut regime. But what's in store further, and especially for someone who's a retail investor, what should be the strategy across asset classes going ahead? And when will we see the burden of EMIs on loans easing out? Hosts of questions here, but then let's take each and every aspect of this. I have with me today on the show Arnav Pandya, founder Money Edu School, to decode all of this. And Arnav, good evening and welcome to the show. So clearly, if we look at the market trajectory today, Nifty crossed 25,600 levels for the first time, Arnav, but couldn't sustain and gave us a flat closing. Talking about the broader markets, they underperformed. Small cap and mid cap declined for the third consecutive session. Um uh, uh, Clearly, can we say, was it in line with the expectation, especially after an aggressive announcement of a rate cut?
Good evening, Kavita. So, if you look at the overall stance of the US Federal Reserve, so start that they have made in this entire rate cutting cycle has been slightly aggressive. But one needs to take into account the entire uh, situation which will pan out over the coming 1.5 years as the rate cuts process gains steam. And that is the most important part of it, that ultimately in when the rate cutting cycle ends, where will the neutral rate end up with in the US? And there it is expected that it should be around 3%. Now, if you translate this into the fact that what does it mean for India, then as far as India is concerned, the Reserve Bank of India is also likely to start cutting rates because, see, the directional movement of central banks across the world is going to be now on the downside, barring an exception like Japan. But if you look at it and try and correlate each and every single move, that is going to be difficult because you've seen the way the European Central Bank or the Bank of England has responded. They are also in the mode of cutting rates, but they have done it, then paused, then moved ahead, things like that. And this is exactly what we will find in India, which is that the Reserve Bank will look at local conditions and based on that, they will take their next steps. Now, in the light of this, what you are going to see on the equity front is more likely to be dominated by the fact that how are other factors playing out, which could be geopolitical factors, which would depend on how the corporate performance turns out to be in the coming quarters, rather than just the fact that the Fed is cutting rates and that will have an impact on the market. So the key to watch out for is the fact that how are you going to position your portfolio both in terms of an overall asset allocation mix as well as the distribution within a particular asset class as the Indian economy also sees a rate cut on the anvil.
All right. Now, what we usually see is once there is a rate cut announcement from the US Central Bank, we see rest of the central banks also following the same suit. We just saw ECB doing it. But surprisingly, Bank of England did not cut their rates after the last night's announcement. And I think they had a rate cut somewhere in August. But after that, it was expected that there will be a constant continuation of rate cut, which did not happen. Having said that, India will definitely follow the suit because we also are concerned about the levels of rupee. Having said that, what are the triggers or the factors that RBI governor would consider? And are we are we in that position to be so aggressive as the US Fed, or we will start with the marginal cut, which could be around 20 to 25, and that would be the right kind of stance and cut considering the Indian economy?
So if you look at the situation in the Indian economy, the focus of RBI is going to be on inflation and specifically that part of inflation which is sticky in nature. So you already have an overall inflation figure which is within the RBI's comfort zone, but you still have pockets of inflation within specific items which have not yet been able to give the requisite comfort level to the RBI. And one of these areas is definitely food inflation. So this is going to be an area which is going to be closely watched and which is in a way going to determine how the RBI will proceed going ahead. The second part of your question, in which is with respect to the kind of rate cuts that you will see in India, I do not expect a very aggressive move from the RBI in terms of, say, a 50 basis point cut. Whenever it happens, I expect it to be, at least for the moment, it looks as if it's going to be the range of 25 basis points. And in here also in India, you are likely to see pauses at various times of in as the various meetings of the RBI NPC go on into the next year, because the if you look at the changing dynamics across the entire economic spectrum, you will find that there will be several data points which come up, which cause for this kind of pause to see whether things are going appropriately, because we already have a strong growth rate in our economy. So the RBI also wants to ensure that they do not overheat the economy, which can cause a problem later on. And which is why you will find that RBI is going to be very cautious when they go about this entire rate cutting process. But foreign retail investor, the point is very simple, that you are in a mode where interest rates are going to go lower. So it's going to benefit you on the borrowings, and you have to position your portfolio accordingly as to what is expected.
Talk about your portfolio now, and in fact, before talking about your investments and your financial portfolio, let's look at the burden on the EMI. Loan borrowers are just waiting for a rate cut, and although even after the rate cut announcement, whatever percentage or whatever BPS it is, it will be it will translate to the loan borrowers in a couple of months whenever they have the loan setting period. But just the thought that we are now in the rate cut regime also in India, and one day finally we will see the interest rate on our loans going down. It's quite a relief mindset, and looking at the EMI's burden going up, having longer loan tenures and higher interest rate. Has been causing a lot of financial pressure on a lot of people. Although we've also seen a lot of household savings going into speculative investment instruments, but that's a different topic of discussion. When can you see some kind of a relief or respite as far as the loan EMI is concerned and loan interest rates are concerned?
So as far as the loan EMIs are concerned, all the new loans are now linked to an external benchmark. And there, I mean, the process is very simple. The moment the external benchmark goes down, in which case, if that is the repo rate, then that flow through will happen, and the next resetting period will see a lower rate for all the consumers whose loans are linked to this external benchmark. So, for a person who actually witness a relief as far as their loan rates are concerned, you will have to wait formally for the RBI to start cutting rates, and then the benefits will flow at a later stage. But it's always important, or rather, it's always a relief to know that at least the trend is now very clear, which means that the expectations of rate hikes are now not there, which means that at least the burden in terms of an increasing tenure, which people have been suffering over the last 3 years, and which has thankfully stopped since the rates have stopped going up, that is no longer likely. And which is why once the RBI starts cutting rates, you will find that the flow through effect will start coming in for people and their borrowings. And specifically because you find that most of the borrowings now are floating rate instrument ones. So that impact will flow into them.
So one needs to really be ready for this and strategize it accordingly. But then what about your portfolio strategies? How should one be looking at equity? And having said that, a lot of fans of fixed deposit around, especially in the investor fraternity, because there's some kind of a comfort factor that still prevails as far as fixed deposit is concerned. Time to lock in fixed deposit at a higher interest rate right now, and especially for senior citizens where you're really getting attractive interest interest rates on fixed deposits, Arnav?
So I would say that one is that, see, based on your overall requirements and goals, you need to have a specific asset allocation. Within that asset allocation, you need to look at what instruments are you going to use to achieve your exposure. So as far as equity is concerned, it is time to ensure that you are cautious in your approach, in the sense that you have seen this kind of rally go on for a very long time. And the kind of frenzy that you are seeing specifically in parts of the market now, you can see that in the IPO market, that is likely to cool down. But you have to ensure that whenever you are looking at the equity exposure, you have a quality portfolio, and that the balancing of risk among various market caps is taken care of. Now, when you come to the fixed income part, there are two factors which are affecting fixed deposits and the rates which the banks are offering. One is that for a long period of time, you have seen that the growth rate of advances for the banks has been more than the growth rate of deposits. So they are facing this kind of liquidity crunch, which is forcing them to have a higher interest rate offerings for the customers to get more deposits. The second, which is more structural in nature, is that Indian investors are moving away from the traditional habit of parking a lot of funds into fixed deposits, and they are moving into mutual funds and other areas. So there is a shift in terms of the money moving away, which is also resulting in a need for the bank to get more deposits. Now, both these conditions are not likely, at least the part about the shortage of funds might not be there for a long period of time. And which is why, for those people who have fixed deposits as a means of investment, which they are preferable for it, they should ensure that at least the higher rates which banks are offering for specific time periods, that they can make use of. At the same time, they should also ensure that the opportunities which are there in debt funds is also not missed out, and that they are making use of this, because you are going to find that there are a lot of categories of funds which could be both longer tenure funds or even corporate bond funds, where there are good opportunities to lock in your money and put it away for the long term, so that when the actual impact starts getting seen more and more in terms of the secondary debt market, you are able to earn a slightly higher return, because then not only are you benefiting from the coupon rates in terms of the income which is coming in, but the fund also earns capital gains, which adds to the overall return of the investor.
Sure. So these are the rebalancing strategies that one must really consider, looking at the rate cut regime now, and it's likely to catch up even in India as well. So it's time to realign your portfolio, taking this very important trigger under consideration. Thank you so much, Arnav, for being on the show and helping our
Thank you.
viewers with their portfolio strategies today.